Hello traders, Gary Wagner here just after 10:30 in Honolulu, 4:30 in New York. It is Tuesday, March 14th, 2017, and this is the Daily Report for Gold and Silver. Fed Day began today, concludes tomorrow with the most current FOMC meeting getting underway today. Of course, we'll touch upon topics throughout today's show, but what we are witnessing is a further decline in precious metals pricing, with gold plummeting through $1,200 per ounce. Currently, as we look at gold futures, that is trading at $1197.90, putting it off about $5.20. And traders, the majority of this sell-off is all dollar strength. In fact, when you look at the Kitco Gold Index, what you will see is on a $5.20 decline, 90 cents of that is due to selling or normal trading in the market, and the remainder due to a stronger dollar up over 0.4%. We'll look at that in a second. In terms of ranges, we've seen the low today at 96.90, so we're just about $1 off the low, and the high on the day, 12.07. The real question is whether or not 1200 will maintain itself as an area of support, which it is not right now, or turn into an area of resistance. Net change today down about 0.45, a little bit over 0.4%. Silver also taking it pretty hard, but net change right in the same aspect in terms of how far it's drawn down, about 0.5% lower, trading down by about 8 cents at 16.89. Again, this is all precipitated by dollar strength. And speaking about dollar strength, as you can see, dollar index currently up 0.47, up 48 points at 101.79. That, of course, all in anticipation of a rate hike being announced tomorrow at the conclusion of this month's FOMC meeting. So any way you want to look at it, there's no doubt about it, but there's a continued pressure to the downside in the precious metals markets. When we look at gold, this of course being a daily chart, we can see today's sell-off roughly about $5. As I said on the opening statement, this is really predicated by dollar strength, and the hard break that we have seen to the downside does continue. However, in terms of any kind of ray of hope or sunshine, we've got 1198. That is the 78% retracement. This is the band that we're looking at as a critical band, down to about 1194. The market is currently at 1198.40. So as you can see, we have not really penetrated through this particular price zone with any kind of vengeance yet. And so it is possible that we do find support in this area. And as I also said in the opening statement, the key is going to be whether or not this price point maintains itself as a supportive area, as it has in a very weak and meek way, or whether or not it becomes an area of resistance. And traders, it becomes extremely apparent as to the current sell-off when we look at the weekly candlestick chart. We identified, of course, an engulfing bearish that occurred 2 weeks ago. Last week, of course, was our confirming candle, a lower high, a lower low, and certainly a lower close on the week. You can see that by the nature of this red candle. Now we've got, as of this week, and of course it's only Tuesday, a lot can happen, and especially with decision day tomorrow, anything can happen, but we certainly have the beginnings of a red candle. And on a longer term basis, the area that we really want to look at is going to be an area between a 75 and 78% retracement of the overall rally that began effectively at the end of last year, beginning of this year at about 1120, and concluded at the yearly high that we have achieved roughly at 1260. The reason for that is there are a multitude of models that are bullish in character that would look for a rally and then a retracement followed by another bullish move to the upside. However, those models predicate, or look for, I should say, that particular correction within following the rally should be about a 61% retracement and can really go as far as a 78% retracement. However, after that point, in other words, a retracement that is greater than 78 kind of negates the multitude of bullish rallies, because now you have given up such a huge percentage of the net gains that you have seen that you are really looking at the potential of a bearish model. Now realize we've been dealing with a bear model up until really the beginning of 2016, end of 2015, right in here, when prices really bottomed at their all-time high after dropping for a period of 5 years from 1900 down to here. And the key was that when we look at the action in 2016, it contained a high that was higher than 2015, and that was the first year that we could actually make the statement that when we looked at year in, year out, we had a higher high this year than the prior year. And to achieve that this year again would predicate, or would really confirm, I should say, that we are in a bull model. However, if we do have a lower high than we had last year, and the number, that target we've got to beat is 1380, then that kind of takes all of that optimism really and takes it out of any potential model that I could be looking at. Traders, obviously, we are currently flat with no active trades. We will do that as we go into the Fed announcement tomorrow, and then we will act accordingly and put our game plan together as we get information from the Fed. In other markets that we follow, Dow Jones Industrial Average, along with the other indices, are venturing lower today. Some of it due to the Fed meeting that got underway today, but predominantly due to a continued drop in crude oil, now breaking down again. And we'll look at a couple of oil charts as we go into trending markets, but the Dow Jones Industrial Average giving up about 0.2% to close at 20,837. And as we talked about that gap at 20,800, we at this point have effectively gone and filled that gap. Standard & Poor's down a little over 1/3% at 2362, and the NASDAQ index also down about 1/3% at 5856. But as we talked about, it's crude oil continuing to plummet, continuing to drop. That's gotten many traders and market participants' attention, down another full percentage point, giving up about 50 cents per barrel, and now below 48 at $47.90. As we talked about yesterday, our current target for crude is around 46, 47. So we are quickly approaching that particular price point. So traders, absolutely no doubt we are witnessing the Dow Jones Industrial Average either consolidating or showing the first signs of being top heavy. As we've talked about over the last couple of days, the market moves that we have witnessed have been characterized by a large spurt and then sideways trading, followed by another kind of price hike and then sideways again, price hike, sideways. And so we could easily be witnessing that spike up and then sideways action before moving to higher ground and yet a new record high. Since we haven't had a real correction really in the last couple of years, we can't make that determination until it breaks through a couple of moving averages. And the primary one that many traders follow is the 50-day, and we're so far above that right now that we would long be in a correction before we actually threatened or challenged, I should say, this particular moving average. Now, today's downside move is obviously influenced by crude oil continuing to go lower. And to that end, traders, I've pulled up a daily chart. This, of course, is a continuous contract of crude oil futures pricing. Interestingly enough, take a look at the way the market has hit the bottom of this channel. We talked about this channel line yesterday with the obvious bias to the bear side. But what we have seen is look at these drops that we saw over the last couple of trading days. But beginning yesterday, we had the market trade lower with a lower low and a lower high, closing lower. You can see it is drawn in red, but it is in essence a doji candle where the open and close are the same. We're getting that kind of consolidation today. Look at this extreme low coming to the bottom of this channel, however, closing pretty much unchanged, and we have crude light currently trading back above 48 at 48.46, putting it up 6 cents on the day. So obviously something fundamental has come out, or traders just believe that as it was bid down at these lower pricing was an attractive buy, and they began to bid it up, taking it to, in essence, unchanged. And so the question still remains, as we talked about yesterday, will we see prices plunge below this particular channel line, because in that case we are looking at some extreme lows. We are still maintaining our target at around 46 to 47, but as you can see, 47 is a price point we touched because that amounts to the low that was achieved today. So in essence, we could have hit the bottom of the channel and moved back up, but based upon recent action by the Saudis in which they have increased their production, there is a distinct likelihood that we will see oil continue to trade lower, and what we're looking at right now is just basically short covering. So traders, as we go into market close today and settlement, which is what we are looking at now, we do see gold really settling down on the lows of the day, 1197.30, putting it down about 580. The prints just prior to this were down a little bit over $6. And the question is not whether or not there will be an interest rate hike. That's a given at this point. It's been announced, it's been kind of spread amongst balloons at a party and given out to all the participants. The real question is, A, what will be the extent of the rate hike? And more importantly than that, what will be the posture and the tone from the Fed moving forward throughout the end of the year? And that, my friends, will be revealed in the post-statement comments by Janet Yellen, or hopefully revealed. And at that point, we'll either get more clarity as to the future or more additional pieces of the puzzle to, as I said, the American economic landscape. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for another daily update.